25th year as America's most popular program about the economy, people, and their money. Wall Street Week with Louis Rukeyser is made possible by the Corporation for Public Broadcasting and by the annual financial support from viewers like you. By MFS. MFS helping mutual fund and institutional investors achieve their financial goals since 1924. By A.G. Edwards, serving the investment needs of individuals and businesses for more than 100 years, built on a foundation of trust, research, and commitment to investor success. And by Prudential Securities, with more than 5,600 financial advisors nationwide, Prudential Securities can help you invest your money wisely. Produced Friday, November 10. Our panelists are Laszlo Birinyi, John Dessauer, and Michael Holland. Tonight's special guest is Elaine Garzarelli, President, Garzarelli Capital Incorporated.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when we learned once again what a truly great country America is. How else could a nation survive this lot of politicians? In Washington, the feuding president and Congress engaged in a thoroughly sophomoric schoolyard game of chicken, you're another, and you're worse than I am, I'm not, or two. The subject of their partisan squabbling was, of course, nothing less than the full faith and credit of the United States government. But with another election a mere 12 months away, who's counting? It was not, of course, the first time this schoolboy charade has been enacted in the city of Madison and Jefferson. Indeed, there have been dozens of previous empty debates over whether to raise the debt limit, which, in view of their mutual propensity to spend too much of the taxpayers' money, they always eventually wind up doing. But the threat that this highly partisan Congress and this record partisan president might actually keep sticking their tongues out at each other until the United States government defaults on its debt for the first time in its history was sufficiently alarming this time to send the bond market into a two-day nosedive and to cause astounded holders of American currency around the world to fret about what it really means these days to be sound as a dollar when the U.S. Capitol is increasingly operating like a loony bin. Is it any wonder, then, that the most popular politician in America this week was the one who told us he had absolutely no interest in running for president next year? In fact, that statement alone seemed to make Colin Powell look like the only sensible man in town. Powell once again demonstrated his mastery of the process he claims to find so unenticing by shrewdly waiting until he had signed 53,000 copies of his autobiography before shrugging and saying, "No thanks, but check with me in 4 years." Boy, does that general know how to sell a book. Powell's straightforward composure and concise articulation were particularly noteworthy as compared with the remaining presidential frontrunners in the GOP, which has managed to move in just 7 years from the great communicator to the unbelievable non-communicators. But there should be some great debates next year involving Bill Clinton and Bob Dole, each arguing vehemently with himself, of course. On the other side, we did find out this week what they actually have to do at the Department of Energy these days, and why the government needs so much of our tax money. Energy Secretary Hazel O'Leary spent some of it, it seems, on private investigators to monitor the work of reporters covering her department. Some of them, it transpired, to everyone's total astonishment, were not entirely enthusiastic. Golly, I'm glad to have contributed to that amazing discovery. O'Leary got off with a reprimand and a relatively mild knuckle-rapping from the press. But just for fun, what do you think you would have seen on your television screens this week if Richard Nixon had been her president? And speaking of all the wonderful ways the government finds to spend the money you earn, a study by Harvard's Martin Feldstein, who headed the Council of Economic Advisors under President Reagan, showed in detail that raising tax rates in 1993 had had the entirely predictable result of discouraging extra work and thus diminishing the expected revenue from higher earners. Well, what do you know? It happened again, this time too. But bashing the successful plays so well in the media that there's really no point in doing any actual arithmetic now, is there? Is this a great country or what? We tonight will turn from the phony numbers in Washington to the numbers that really move the world of investments in the company of the most celebrated Wall Street number cruncher of our times. But first, let's see how they were voting in Wall Street in the week just past. Further confirmation that while the sluggish economy is moving no faster than a politician thinks, there was at least no inflation pressure visible anywhere this side of the Federal Reserve, sparked the Dow Jones Industrial Average to its 55th record of the year, up just under 45 points at 4870.37. But the broader averages did notably less well, and the NASDAQ index actually closed down after technology stocks survived their third major sell-off in the past 4 months. For those who still believe in technical analysis, know that our elves repeated last week's +5 buy signal after finally getting off their duffs and acknowledging the biggest bull market of their lives. With the bond market first strong, then weakening, with the Mexican peso touching record lows, and with the guys in Washington demonstrating that their silly season runs for 12 months each year, the gold bugs had their best week since March, though the metal still failed to break through $390 an ounce, not to mention $400 or $420, or for that matter, $875. But one of these days, if Bert Lance ever comes back, my call on the stock market seemed relatively unworried by the shenanigans in Washington. Should it be?
The stock market, Lou, seems to look through the shenanigans, as you put it, and looks at more important things, frankly. Inflation, as you said a second ago, is looking quite good. If anything, the shenanigans in Washington have a disinflationary effect. We have a lot of things that have been going on since the early 80s that have fought against inflation. We have more stuff going on today, including not just Washington, but what's going on in Japan.
Why is Washington having a disinflationary effect?
When they shut down the government, they can't spend a whole lot of our money.
You remind me of after President Reagan was shot and they said, you'll be pleased to hear that the government's been running normally. He said, why do you think that would please me? What do you think investors should be doing around now?
Well, I think it's time, if there is any hiccup in the markets, either the stock market or the bond market, to take advantage of it. And the reason I say that is, once again, back to Washington, what we're talking about is dueling banjos over how much to rein in budget and spending. And I think that what we have here is a number of stocks that look kind of crazy in the technology area, with the rest of the market quite reasonable. The bond market doesn't look particularly attractive now, but maybe this default talk will solve that.
Laszlo Birinyi, what do you make of what's going
on? I think you just have a lot of year-end cross-currents between taxes and people taking profits. There's been a lot of talk about how much people have made this year, but if you look at how much they've made the last 12 months, it's even greater. I think the market's still in very good shape, and still very optimistic.
One of the interesting figures this week was that with the Dow setting a series of new records, pessimism is growing among advisors. Is that unusual?
I think advisors have been wrong in this market from the get-go, and I think too many people have just got themselves in positions where they don't want to admit that they were wrong, and instead of sort of backtracking, they're just screaming even louder and pounding the table harder, which I think, again, is normal given the kind of move we had.
Do you share Mike's view that the technology group's a little overextended?
Actually, I think the technology group is very, very mixed. I think some of the stocks like Texas Instruments, which is trading at 12 or 13 times earnings, even Compact Computer is probably still worth accumulating. Some of the other stocks, like American Online and U.S. Robotics, I think are very scary.
How about the big boys, Intel and Microsoft?
I'd hold them. I maybe buy them on dips. I'd wait a little bit on them. I'm not sure the picture's that clear.
John Dessauer, you watch the whole world. What do they think about what's going on in Washington?
Well, I think they've been voting with the U.S. currency for quite some time. And on the one hand, we have still a very super strong currency in Switzerland. The Japanese yen has softened a little bit, but still the dollar, when you stand back and compare it to the German mark or the Swiss franc, and still the Japanese yen looks undervalued. So I think they have been worried about this kind of possibility for some time. And my guess is that once we get through this situation and normalcy returns to Washington, whatever that may be, at least we don't have the threat of a train wreck anymore, that the U.S. currency is going to turn up against the European currencies as well.
And against the Japanese yen or not?
Well, we're up a bit against the Japanese yen, and I think, yes, we have further to go in terms of dollar strength. In fact, I think later on in 1996, one of the great surprises could be that all these pessimists were wrong again, and this time it shows up in the U.S. currency, because what I see around the world, relatively speaking, despite Washington, the U.S. economy and the U.S. business climate still looks relatively good.
What's the most attractive market in the world, in your judgment?
Well, I think there's still a lot of attraction in the U.S. stock market. I agree on that score. And I think there's another market out there called Hong Kong that now with the Hang Seng below 10,000 starts to look very attractive to me again. And Southern Europe. Spain, you have a market that looks very reasonable, an economy that looks very reasonable, and once again, a political situation that doesn't look so hot. But the combination spells opportunity.
All righty. Now, next Friday, as you may possibly have heard by now, will be our Gala 25th anniversary program from New York City. And I do hope you're planning on being with us. Tonight, to wrap up our special anniversary series of on-air highlights that viewers have requested, we've put together something a little different, a sort of behind the scenes at Wall Street Week with Louis Rukeyser, designed to answer a vast array of viewer questions we've been getting on such world-shattering issues as who writes my material, do the panelists get to see their viewer questions in advance, and other cosmic queries to which all America is apparently breathlessly awaiting the answers. We hope you like it as we show you everything you could possibly want to know about what you don't see on the screen every Friday. If it's Friday, this must be Owings Mills. I've been coming to the studios of Maryland Public Television to do this program almost every Friday for the past quarter century. It began as a bit of moonlighting. I was already a commentator for ABC News and continued as a full-time ABC political and economic analyst for the next 3 years. Since then, I've been out on my own the other 6 days of the week.
Hi, Kelly.
Hey, Lou.
Owings Mills, which I like to think of as the financial nerve center of the universe, is actually a suburb northwest of Baltimore. And though I live hundreds of miles away, this building has become a sort of second home. I generally arrive in the early afternoon, and my first important job is to have lunch.
Hi. Hello, Daddy. I love your outfit.
Thank you.
When I was a young newspaper reporter, an editor once told me that serious journalists should always order ham and cheese on rye, and thereby save their creative powers for their work. I then read every comment that viewers have sent me that week and answer as many letters as I can. We really do have the most loyal and astute audience in the world, and I always look forward to finding out what they're thinking now. Next, I work the phones and check the news a bit, work on a few future projects, and don't actually start to write that night's show until about 4:30 p.m. And yes, I do write my own stuff, every syllable of it. Whose stuff did you think I wrote? I check over the graphics for that night's show, making any last-minute changes, chat with Rich Dubroff, who has been producing the show for the past 14 years and is one of the 3 most conscientious people in the history of television, and around 6, begin writing that night's opening commentary. If inspiration doesn't immediately appear, I look for him in the hall. Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back.
Hi, Mary. How are you?
Meanwhile, the panelists and guests begin to arrive. While I'm typing, they're eating, having makeup applied, and getting acquainted. Natalie Seltz, our on-air hostess in the role of Miss Smith, is making them feel a little more at ease. The crew is getting ready, and so is our director, George Benneman. George is the only other person besides me who has been with the show since it started, and he's been our director for 19 years. He's also an extremely conservative dresser. If all goes well, we pre-tape the show starting about 7:45 p.m. Eastern Time. Otherwise, we do it live at 8:30. If we're taping, Natalie will lead the group into the studio around 7:15. It takes me about 90 minutes to write my opening, so it's usually close to 7:30 when I finish up and pop in to get a little makeup. Please remember that there's only so much they can do with the raw material I provide. Next, it's into the studio, about 5 minutes before showtime. No time, of course, for anything so boring as a rehearsal. I'll quickly check my opening position and say a friendly hello to the guest, whom I will not have seen until then. For a lot of our guests, it's their first time on television, and I try to make them feel at home.
3, 2, 1, showtime. Okay, folks.
The show itself is the easy part, and usually lots of fun. Afterward, those guests who want them get some photographs taken. Most enjoy watching the show with us as it goes out to viewers, and then we'll work on next week's program. On the weeks we use viewer questions, I'll pick them and have them sent to the panelists, who can do the necessary research instead of answering them off the cuff. Even for certified geniuses like our panelists, that's usually not a bad idea. It's generally close to midnight when I leave the building, thinking about next week's show and how we can do it better. I'm determined that we're going to go on doing it until we get it right. But now back to live action drama as we go over and meet tonight's special guest, Elaine Garzarelli. Elaine, welcome back.
Nice to see you, Lou. Thank you.
Delighted to see you. In a world of staid predictors of the stock market, Elaine Garzarelli stands out. After a series of on-target forecasts made her arguably the most widely followed Wall Street guru, she was fired last year by Lehman Brothers, reportedly for a combination of being bullish, indeed a bit too much so, when the firm was being bearish, way too much so, and for being too expensive. She's solved that problem, though, by forming her own firm, Garzarelli Capital Incorporated, where she has taken her indicators and her independence. Elaine, while some others have argued that the bull market is topping out, you have recently grown more bullish. How come?
Well, because actually we've been bullish, but the more interest rates drop, the more bullish we become. The earnings have been coming out on the S&P 500 higher than all my estimates. So I think that the reorganization that's gone on in the last couple of years has really given us earnings better than the consensus and better than my numbers, which are usually high.
Well, we're over 4,800 now. Where might we go next year?
It sounds very high, but after running it today, and as you know, we had a bond market that had a little drop today, 15 to 20% from here. Sounds like a high number on the Dow.
12 months.
12 to 18, I would say, and that's a number like a 5,500 to 6,000 type Dow number.
You've mentioned the interest rates supporting you. Are you afraid that interest rates might back up a little bit if the economy picks up later in 1996?
I really don't think so, because I think that interest rates are still, they're at equilibrium right now based on the rate of inflation and based on the deficit as a share of GDP. And I think with the balancing of the budget over the next 7 years, and that will happen, I mean, if we default, there's probably a 1% chance that we'll do that. But at least there's a lot of publicity, and at least something will be done, even more than has been done with the budget deficit. It's gone from 5% of GDP to 2.5% since Clinton was elected. And inflation is now below 1.5%. So if you factor that in, those are the two determinants of interest rates. You're talking about rates that can go now from a little over 6% to 5%.
If the market's going to have a 15 to 20% rise in the next 12 to 18 months, where are the best stock picks now?
Well, that 15 to 20% doesn't assume any decrease in interest rates or any rise from here. That's if they stay where they are today. The stocks that are going to do the best for the next 6 to 9 months are going to be what we call non-durables. I think we're going to have a 6-month period when earnings for the S&P 500 will decline, and that's not really in the consensus. The consensus is about 15% higher than I am. So I think that we want to be in some non-durable areas like tobacco, where they have steady earnings. As the S&P earnings come down, those earnings always go up. The food industry, people eat, they don't cut back on food. Alcoholic beverages, Seagram's is a good stock in that area. And then you can start on the bad earnings reports, because these stocks have already discounted it. The early cyclicals, which are things like home building, the first thing that gets hit, and it's down 50% when the Fed first started tightening, household appliances, automobiles. So it's a combination of some early cyclicals. When the earnings come out poorly, it's an opportunity. and for right now, the non-durables.
Okay, for the next 6 to 9 months, you say eat, drink, and be merry. Right. But early cyclicals suggest you think that we're entering a new upsurge in the economy. Is that your expectation?
Well, I think that we're in a soft landing, and the soft landing will be occurring within the next 6 to 9 months. In the first, second, third quarters of '96, we'll be landing. It will not be a recession, and I can tell you that if there's anything that could cause a recession, Greenspan would ease like that. That's not what he wants to do. He started tightening preemptively this time, and he wanted a soft landing, and then he found out, hey, we really don't have any recession. I'm sorry, we really don't have any inflation in the system. And the bond market was wrong, and we went from 8.20 on the long bond down to 6.
Elaine, you have 14 indicators. I only have 3 with me tonight, so let's hear from them, starting with Mike Holland.
Thanks, Lou. Elaine, since the 1980s, you've been an advisor to many of the largest institutional investors in the world, not just the U.S. What is the dumbest mistake you've observed them make, and what can the viewers learn from that?
Well, a lot of them go with the consensus, and I found that to be a contrary indicator. So the more people that are bullish, the worse it is for my indicators and vice versa. And also the biggest mistake a lot of the big ones have made is they've retired, and then they've come back. They just really needed a vacation.
Elaine, what about gold?
I think that's short term, and I think that's just the uncertainty of what's going on now with the problems between the Congress and the President. I don't see inflation as a problem for many years to come, and I think that's based on a lot of things. Productivity, population changes, slower GDP growth, and I think there's nothing like bonds, and we're not in a depression or recession, then the stocks will do even better.
Elaine, the low dollar gets a lot of credit for the rise in corporate profits and therefore the rise in the stock market, and that now translates into fear of what might happen should the dollar go up. Do you agree with this fascination with the U.S. dollar and the stock market?
Well, when the dollar goes up, it's not good for earnings. It's better if the dollar goes down for earnings, and it's better when the dollar goes down if we want to invest individually overseas. But I think the dollar's probably in a trading range. You know, it's appreciated a little bit, but relative to other currencies, I see a trading range of probably 5% either way, up or down, for the next 12 months.
Elaine, you've told us which groups you favor. How about some favorite names?
Stocks. Well, one of the ones that does the best, this is incredible, every single time the Fed eases over the first year. Textile apparel industry, Liz Claiborne down 50%. Chrysler, way down. Centex, it's a home building company, it's down 35%. You can buy a trucking stock down 50%, Roadway. So there are a lot of things that have gone down as if there is a recession here, and when everybody sees the earnings are good and it's a soft landing, they're going to move up, and they're very small percentages of the S&P, so they tend to outperform by 30, 40, 50%.
You often pick within a group the one that's been hit the most. Is that deliberate?
Yeah, I usually do.
Do you think the whole group comes back and the one that's out of favor is going to come back the most?
Yeah, as long as there's not a problem with the bankruptcy or, you know, something like that, like a Kmart situation. What's
the single thing that could turn you more bearish?
Very, very simple. Interest rates going up. If interest rates went up 1.5 points from here, my indicators would turn negative.
Short-term interest rates?
Both.
What are your predictions for interest rates next year?
I think short rates are going to come down from where they are. Of course, they're artificially up because of the last 2 days and the crisis that we've had. So I think the Fed will ease again, and I think they'll come down probably 50 basis points, and I think long rates will stay between 6 to 6.4, and then eventually come down to 5 over the next 12 to 18 months.
Would you change your mind if more of your colleagues joined in your forecast?
No. Sometimes they're right.
Thanks very much, Elaine Garzarelli, for
Thank you.
Your usual iconoclastic and clear forecast on the market. Thanks, too, to our panelists. Hope you'll be back with us again next week for the event of the quarter century, at least around here. It's our gala celebration of Wall Street Week's 25th anniversary, and some of your all-time favorite guests and panelists will join me on the stage of the New York Historical Society for a very special night to remember. And it won't be complete without you. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.